This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 6 of Value Investing. In this week's episode, I'll be talking about two topics. The first topic will be about the time when Warren Buffett completed 10 years of investment partnership operation very successfully in terms of performance. Instead of celebrating his outstanding performance, Warren Buffett talked about why the past 10 years performance would not be replicated in the future. And the second topic is a good segue because he thinks that it is in the best interest of Warren Buffett himself and his limited partners to liquidate the investment positions because the future does not seem to look great. I think it's going to be a very interesting episode. Before we get into the details of these two topics, I just want to mention that please subscribe to my channel wherever you listen to your podcast and leave your feedback because I think your feedback is very valuable for me to put together different topics related to value investing. So why don't we get started? Let's look at investment letter that Warren Buffett sent out to his limited partners in 1967. And this is the time when Warren Buffett had 10-year anniversary of his investment partnership operation. So it's a big moment for celebration. So his performance to limited partners was 843 cumulative return, which translates into 23.8% annualized rate of return. Whereas the Dow during the same time had gone up by 148%, which translates into 9.1% annualized rate of return. As you can see from the figure, it's a big accomplishment. His limited partners earned 6 times more than the Dow during the same investment time horizon. Instead of celebrating this huge accomplishment in his letter, instead of bragging about his investment performance, what Warren Buffett chose to do in the letter is that he emphasized the investment performance would not be replicated in the future given certain circumstances. And he laid out 4 reasons why he believes that future performance is not likely be the same as the past performance. It's just quite fascinating. Why? Because Warren Buffett is in the business of managing other people's money. What he's basically telling here to his clients is that you're not going to have good performance in the future and you can pull out your money if your expectations are high given the past 10 years investment performance. I think in that regard, Warren Buffett was 100% honest with his investors. He used many pages of his investment letter to explain why he thinks that it's not likely that future performance is going to be as good as the past performance. The first reason that he laid out there is due to a changed market environment, resulting in a sharp decrease in the number of obvious quantitatively based investment bargains available in the market. When Warren Buffett tries to buy a stock or tries to find a good investment opportunity, he looks at 2 factors, one qualitative factor and the other quantitative factor that are associated with the company. On one extreme side, people may say that you can buy the right company with the right prospects and the right management team and the price will take care of itself. On the other extreme of situation, people may say you can buy the company at very cheap price and the company and the price will take care of itself. Warren Buffett mentioned in the letter that money can be made with either approach. And he also noted that the real big money tends to be made by investors who are right on qualitative decisions. But more sure money tends to be made on the obvious quantitative decisions. And Warren Buffett thinks of himself as a person being more quantitative side. When he looks at the market in 1967, he cannot really find such statistical bargain anymore after 10 years of his investment partnership operation. So this is why he thinks that his strategies, investment strategies, may not be relevant anymore after 10 years of operation. And that's why he thinks that future performance is not going to be as good as the past 10 years. The second reason Warren Buffett mentioned in his letter why he thinks that future performance is not going to be as good as the past performance is that there's mushrooming interest in investment performance for the short term. When Warren Buffett laid out his ground rules, one of the ground rules says that Warren Buffett needs at least 3 years for investors to assess his investment performance. So it's a quite long-term time period for a lot of people investing their money. The reason why he believes that at least at the minimum 3 years are required is because less than 3 years, anything could happen. There is so much randomness in the market, and people without any investment knowledge can make huge investment gain just by pure luck. Due to market volatility in the short term, your investment performance may look really poor even when you had the right investment decision in the long term. So that's why Warren Buffett thinks that investment performance should be measured at least with the time period of 3 years or more, preferably. However, when Warren Buffett wrote this letter, a lot of institutional investment firms started to report their performance on a quarterly and monthly basis. As a result of the trend, the payoff for superior short-term performance has become enormous, and the larger and larger amounts of money participating on a shorter and shorter time span became more prevalent, and that actually led to more speculation in the market from professional investors who feel they must get on board and they don't want to miss out this great speculation opportunity. And such activities created very difficult market for Warren Buffett to participate, and he clearly mentioned that he's not going to participate in the speculation. And that's why he thinks that there's not many statistically good opportunities in the market because overall market just went up too much. And the third reason that he mentioned is that his now capital base has grown to be large, and that actually limits his investment opportunities. When he first started his investment partnership with $105,000 from family members and 3 close friends, he had a lot of investment ideas that can be utilized and put into place for his investment partnership. And there were substantial numbers of securities selling at below its intrinsic value. And now those opportunities are gone. They don't exist anymore. So the situation has changed dramatically, and given the fact that Warren Buffett had $54 million asset under management, he feels that there's going to be less opportunities for him to take advantage of, because if you just find small opportunities, then those opportunities will not make a dent and make any meaningful impact on his portfolio. So he has to find bigger and bigger opportunities as his capital base grows to the next level. One thing that I also mentioned here is that even though he mentioned this one multiple times, and back then his investment portfolio was only $54 million, but he started to mention about the size of portfolio and how it's going to have negative impact on his investment performance going forward. What's quite fascinating is that his capital base has grown to billions and multi-billions, and he kept making really good performance in the future. But I think that he wanted to be honest about his opinion to his investors, and he wanted to lay out these kind of limitations and constraints that he has as his capital base grows. The last thing that he mentioned, but he said that this is the most important reason why he believes that his investment performance is not going to be good, is based on his personal motivation. 10 years ago, when he first started his investment firm, he was young and he was poorer and he was more competitive than Warren Buffett in 1967. So after 10 years of operation, his personal conditions have changed. I mentioned this one before in one of my early episodes, that when he first started his investment partnership, he just set out his goal to be 10% above the market. And I was quite shocked because he officially said that he's going to make 10% above the market. It's just not typical of Warren Buffett. But he said that here in 1967 letter that he was just running the treadmill at full speed when he was young and he was ambitious and he set out this goal. But his self-analysis told him that he will not be capable of all-out effort to actively participate in this goal. So he wants to tell people who have entrusted their capital to Warren Buffett that he's not going to be active just in terms of pursuing the economic rewards for his investment partners. And he's going to focus more on other side of his business, which is control businesses, where he liked people, he liked the nature of business. So that's more of his focus going forward. And he thinks that that's more enjoyable and he doesn't have to spend a lot of time just to maximize the investment returns for his investment partners. After all this, he laid out his long-term goal and he said that his target is to achieve the lesser of 9% per year or a 5% point advantage over the Dow. So this is quite modest goal, and as you can see now, in retrospect, Warren Buffett was able to produce significant returns even after this kind of statement. I don't know why Warren Buffett tries to underestimate his ability, but I think he was very candid with his investment partners that he cannot really produce outstanding results over many years ahead. So why don't we switch gears to the next topic? I think this is going to be a good transition of subject because the next topic is going to be about liquidating Warren Buffett's investment partnership. This topic was in May 1969 investment letter, and this was 2 years after he published all these reasons why he thinks that his investment performance would not be good in the future. But over the course of 2 years, he still had outstanding performance for his investors. One of the reasons that he mentioned, we just talked about, was his personal reason. He said that he's not going to be able to do all-out effort to focus on finding good investment opportunities for his limited partners. But guess what? He said that as long as he's in this position, he can't help but just spending all of his time to do the research and find out a good investment. He thinks that it's in the best interest of Warren Buffett himself and his limited partners to liquidate whatever positions they have and cash out. I think this is very interesting point because if Warren Buffett were to just stay where he is, it's profitable business. He was making tons of money. He was able to charge high fees to his clients. Financially, it's Warren Buffett's best interest to keep this partnership. But everything's considered, not just financially, Warren Buffett decided to liquidate the position. So he gave out 3 options to investors. First option is cash out option. So if you were one of the Warren Buffett's investors, you could have just cash out at this point and move on with your life. This first option is the worst option that you could have chosen if you had been Warren Buffett's investor at that time. Hindsight is 22, but this one was the worst option in retrospect. And the second option is also very interesting. He said that I'm going to give you an option of maintaining your proportional interests in the two controlled companies at the time. Number one, diversified retailing company. And number two, guess what? Berkshire Hathaway. So if you choose this option and stay there and put your proportional interest in Berkshire Hathaway and diversified retailing company, you're probably by now you're billionaire or millionaire, at least multimillionaire. Yeah, I didn't really do the calculation, but Berkshire Hathaway has been super successful, and that made Warren Buffett multi-billionaire, and that made many people around him multi-millionaire. So this one was definitely a good option. The third option is also very interesting. Warren Buffett said that if you want to put your money in the money management business, then I'm going to recommend you one guy whom I really trust, and this guy has integrity and ability to perform better than the market and potentially better than myself. That's what Warren Buffett said in his letter. He said that it's probably not in the best interest of Warren Buffett to recommend this person because there's nothing for Warren Buffett to gain personally, and there's a considerable things that Warren Buffett can lose. So if future results turned out to be excellent, then it would not do any good to Warren Buffett financially. And if something goes wrong, then Warren Buffett might well get a portion of blame. However, Warren Buffett believes that he has the responsibility for his limited partners who want to put their money in the money management business to recommend sound investor, an investor that Warren Buffett trusts, even though it's not going to do any good for Warren Buffett. The million-dollar question that you have is, who is this person? His name is Bill Ruin or William Ruin. Warren Buffett and Bill met in Ben Graham's class at Columbia University in 1951. Warren Buffett said that he observed his qualities of character, temperament, and intellect since that time. If you look at Bill's overall track record at the time of Warren Buffett writing the letter, it was about the same as Warren Buffett. So he was super good. But Bill's performance had a lot more volatility in the portfolio. For example, from 1956 to 1961, for about 5 years, Bill had excellent performance. He had 40% annualized rate of return during his first 5 years of operation. However, the following year, 1962, his portfolio went down by 50%. That's a lot. And next year, he had break-even year in 1963. And the following 4 years, he went back to 40% annualized rate of return. So his performance has been quite volatile, but still Warren Buffett has trust in his performance based on observation that he had in Ben Graham's class, and he kept in touch with Bill during his investment partnership period. Warren Buffett said that if he were to die for whatever reason, then he would entrust his money to Bill for his family financial matters. And that's how much Warren Buffett had trust in Bill. So who is this guy? I was quite curious, and I did some research. And I found one article from the Washington Post. Bill and partner Richard Conniff founded their investment management firm in 1969 after raising $20 million from investors, and most of their customers came to them on the recommendation of Warren Buffett. The company's name is Kuya Fund, and you guys probably have heard of this fund name. And the Washington Post article says that the fund has been so successful and has substantially outperformed the S&P 500 index since its inception in 1970. And it was so successful that it has been closed new business since 1982. Another article from Forbes noted that if an investor had placed $10,000 with the fund at its inception and had reinvested the dividends, he or she would have had $1.1 million after 29 years when Forbes published the article. What's quite fascinating here is that Warren Buffett was able to spot great investor when he closed down his own investment fund. And it's just not just investor. If you look at how Warren Buffett acquired businesses, and the first thing that he looked at is the management team, and he was able to tell right off the bat whether the management has really great integrity and is competent also with their businesses. So this is extraordinary skill sets that Warren Buffett has, and it's really hard to learn something like this. You have to know how to assess other people in both qualitative manner and quantitative manner. It's just same as assessing the stocks. But Warren Buffett had that ability and was able to spot Bill way in advance before he became successful for his Kuya Fund. Okay, that's it for this episode. If you haven't already done so, please subscribe to my channel wherever you listen to this podcast. In the subsequent episodes, I'll continue to talk about Warren Buffett, and there will be a lot of interesting topics. So I'm so excited, and see you next time.